familiar with this myth, the myth of the money multiplier. This is the idea that essentially banks are limited by the central bank according to the amount of reserves that they hold, and if there's a reserve ratio, in this case it's a 10% reserve ratio, that there's a sort of mathematically finite amount of lending that can go on in the economy. So you start off with £100, the bank can then, that's deposited, and the bank can then use that to lend 90 with a 10% reserve ratio, holding on to 10, etc., runs on through the economy. You end up with £900. Another way of presenting this is in this kind of way. You've got these are cycles of lending going along the bottom. The dark green is the so-called base money, central bank reserves, and then the amount of lending upon which you can make. It gradually runs out over time, the additional lending being the grey. So the easiest way to think about it in some ways is as this kind of triangle. We have a monetary base, and the banks can lend upon that, but gradually their lending is kind of reduced over time. The idea is that creates some kind of stability. Now, the truth of the matter is that this is no longer the case. In the UK, as Ben explained, there is no compulsory liquidity reserve ratio or deposit ratios, as it was described. That was completely abolished in the early 80s. And you know, this idea that there's a relationship between central bank reserves and actual commercial bank money, there's no evidence for it really at all. And this is a nice example to show that from the book. Figure 5. This shows the collapse of commercial bank lending, the top chart. These two charts are on exactly the same calendar, by the way. We're starting in June 2000, running up to January 2011. You can see this massive collapse in bank lending. And this is bank reserves at the Bank of England, central bank reserves. You see here they're completely flat with all this high level of credit. There's this collapse. They pump 200 billion reserves into the system, into the banks, and lending just carries on going down. So you know, there's no relationship there. And the Bank of England, you know, Paul Tucker again basically admits here that base money comprises neither a target nor an instrument of policy. So this is what it really is a better way of thinking about that relationship. It's essentially a kind of balloon. There's these reserves that are required within the system, and I'll explain that in the next couple of slides. They're required for interbank payments, and banks essentially lend on the basis mainly of their confidence, as we've discussed. You know, if they think people are going to pay back their loans, or if they've got ways of, you know, de-risking the loans through securitization, they'll make loans. You know, and they just need to have enough reserves to clear at the end of each day all their payments with other banks. And there's a nice quote here from Charles Goodhart, who wrote the foreword to this. The base multiplier model of money supply determination is such an incomplete way of describing the process that it amounts to a misinstruction. So banks, as I say, when you pay some money into your bank, if you bank at HSBC and you pay some money to Barclays, it's not actually commercial bank money that's created by banks that moves. Effectively, what happens is central bank reserves are moved from HSBC to Barclays. Okay, that's the only way banks can settle with each other within the closed loop of the intrabank payment system, which is represented in this diagram on page 63 of the book. Okay, central bank reserves can only be created by the central bank, and they can only exist within the interbank market, the interbank trading system. We can't get central bank reserves. This is just a different kind of money. It's a money of final settlement within the banking system. Okay, because when a bank creates new money, as we've seen, it makes a loan. The money itself is a liability. It's an IOU. And banks can't use IOUs between it and me or it and HSBC and you to settle with other banks. They have to use central bank reserves. The central bank is the lender of last resort. Its money is the most liquid. It's quite complicated to explain the history of how this came about. 5 minutes, okay, we have to speed up. But please read chapter 2 and you'll find out exactly how it came about. but essentially, you've got to, each bank has to hold enough central bank reserves to pay all the other banks in the system. And what they do is you have this interbank market where they trade the reserves between each other, usually in exchange for government bonds, okay, which are also a very liquid kind of asset. So every day, these reserves are swapped between the banks on the interbank market, and they charge interest upon them. The LIBOR rate, the interbank interest rate, shot right up during the financial crisis because banks lost confidence in each other's own solvency, right? They stopped believing that if they made a loan of reserves to another bank in the system, that bank would actually be able to give them back the bonds that they're exchanging in the loan and pay the interest. So the interest rate shot right up on reserves, on the repurchase agreements that the banks have between, and the whole system almost came to a complete collapse. And that was the reason the central bank pumped in 200 billion of reserves in quantitative easing to create more liquidity within the system. Okay, so now all the banks are flush with these reserves, but as we've seen, they're still not lending. So despite all of this quantitative easing, it's still not working.